Welcome, everybody. My name is Richard C. Wilson of the Family Office Club, and today we're hosting a virtual investor discussion panel on technology. We have many investors here today on the panel. They're going to introduce themselves, kind of go through a little bit about what their background and perspective is, and then we're happy to answer your questions here live. We'll be recording this for our member portal. We have now around 170 discussion panels recorded in the portal on all different niche topics. We've probably only done a handful on technology specifically, but we also have in the portal investor mandate interviews. We've done about 90 of those one-on-one 7-minute video interviews, and at least 15 of those, if not 20, I think, are tech related in some way. So if you're here, you might want to also check out those interviews. Catherine, why don't you go first and just introducing yourself for 1 or 2 minutes, and then we'll go down the line.
Okay, thank you. I am co-president of the and have been in the investing as an angel business for over a decade, actually 20 plus years if you count earlier career investments. I am a broadly networked syndicate manager, so I have a lot of friends all the way across the country, up and down the West Coast. Invest in deals, primarily the early stage, but also participate in later stage Series C and D investments through multiple venture groups. In addition to that, I also consult with growth stage companies, and so am involved in their strategy overall in go-to-market, business model, team alignment, and so on. I would say I'm reasonably informed on scaling challenges encountered by companies as they go through their growth.
Sure, great, okay, thank you. And Gary, what about yourself?
Sure, I'm the founder, managing director. I launched in 2010. We're located here in the Silicon Valley as well, actually in the South Valley, a little south of San Jose. My background, like many, is two distinct sides. I came out of the technology world when I got out of the Army. I actually started working for a defense contractor and led their R&D and for 15 years. So I've pretty much worked on everything from combat vehicles to lifestyle apps. I launch a lot of incubators globally and work with them. And I work with a lot of foreign governments and so forth on what normally would have been boot camps and stuff coming to the United States to expand companies. Well, now it's all being online. So we're working with Armenia for the first time starting September 1st with 15 companies. So that's most of my background. Again, I'm here in the Silicon Valley, but I'm globally connected. Like I said, I mainly work in ecosystem modes, kind of like connections and so forth as much as anything. But we tend to focus a lot in the tech area, obviously being in the Valley. And we also do ag tech as well, being between Silicon Valley and Salinas, so to speak. So we tend to bridge that gap as well.
Sure, okay, great. John?
John's northwest side of Chicago. We're a multifamily office wealth management firm, directly managing a little over 800 million and then advising on several billion of total family wealth. We really do look at it as that integration from strategy to execution for the client families that we serve. We've got families across 30 states in the U.S. As well as Western Europe, and then a bit more of a outsourced chief investment officer when we think about single family office management. Gary, thank you for your service coming out of the Army and anyone else that's there. So it's great in terms of putting these forums together. Richard, thank you again for having us.
Sure, thanks for being here. Skip?
I'm with an economic development organization called in Ann Arbor, Michigan. And what we discovered in much of our work over many years, working with entrepreneurs and helping researchers in particular get companies launched and educating them on how to grow a business, how to create a business and grow that business and then raise capital, we found that the missing link in our state was angel capital. We have VCs, but we didn't have a lot of angels. And so we as an EDO, recognizing a challenge and an issue, decided, okay, let's jump in here and figure out what we can do. So in 2012, we created an angel group called It is the largest angel group in the state, and we've been investing since late 2012. We are narrowly focused geographically in that we only invest in Michigan-based early stage startup tech companies, but we're industry agnostic. So we don't really care as long as there's a technology and the ability to scale.
Sure. Okay. Great. And Ron, I think you might be on mute still, but if you want to introduce yourself next. Otherwise, we can have Ian, if you want to go next, we can get back to you, Ron, just a second.
Sure, Richard, thanks. It's nice to be with everyone here today. A good day. My name is Ian. I'm the chairman of was the first high-tech angel group in the United States, and to one degree or another, most other angel groups have drawn from our pioneering experience in making early stage investments in high-tech companies. There are now literally hundreds of angel groups across the country, and they went from being a questionable feature of the dot-com era to now an old and recognized piece of the financial food chain for early stage investing. There are lots of new kids on the block, from Angels List and Kickstarter to super angels and accelerators and micro VCs, but angels and angel capital, either individually or in groups, are an established part of the food chain. So much so that many angel clubs, including ours, have side funds that very much resemble VCs. I'm also the general partner of the Band of Angels Acorn Fund, which makes direct investments in seed stage deals. This is the third fund we've had under the Band of Angels moniker, and I'm pleased to give ourselves a plug that just this month, literally last week, we returned 100% of our investor capital. And we're doubly pleased that our remaining investment in Airbnb looks like it's going to go public in the fall, according to news accounts. So we're looking forward to having a profitable fund and seeing what comes next. Nice to be with you.
Yeah, it's exciting. Thank you for being here. And Ron?
Sure. Ian, thanks for the update on profitable exits. Always nice. And we're in the unique position to realize how rare it is to get a 10 banger or more. So it's great. So my name is Ron, and I'm a super angel. So we like to invest in young companies that target enterprises with software, either that enterprises would use or they would eventually partner with to have the go-to-market strategy complete with the enterprise. So we've invested in many companies over the years. We love technology, software especially, and we work with the founders. I personally have a background in technology. I own a software company with many customers like the Bank of America, JP Morgan Chase, Wells Fargo, Barclays, and many others. So we like to add value. So when we invest really
Cutting out a little bit. Might have lost you there, Ron. Well, I can jump into the
value either in extending technology capability. Okay, are we good?
Oh, there we go. Yeah, I think you're back now. What was the last half sentence or sentence there?
Yeah, so we look for founders who are very talented and very ambitious. So we have an investment model where we don't read too many business plans, because once we have an initial discussion with the founders, we give them these 10 questions. And if they do come back, which actually is a very small percent do, then we will engage further. But these qualifier questions really do help the cause to minimize the time and effort in due diligence and to weed out the talent and ambitious from the talkers.
Yeah, that's great. I'm sure just like Skip focusing on Michigan early stage, it just eliminates most people contacting you on Human Earth and makes your life more simple on some level. And Ian, what was the year you got started? Was it like 1975 or something?
Oh, no, not that long ago at all. Truly, people are surprised at how recent organized high-tech angel investing is. The founded in 1994, so we just completed our 25th year. I joined in 1997, so I've been doing this now for 23 years myself.
Wow.
But really, the media articles in the 90s were all about whether angel groups were a feature of the dot-com era or not. So it was definitely the evolution of the American financial food chain, which at one time VCs were the new kid on the block in the 60s and 70s. The 90s were when angel groups were the new kid on the block, and now we're old hat.
Right. Yeah, kind of like family offices a decade ago were relatively unknown, and still the average person who doesn't work in finance has no idea what a family office is. And I think some of my friends think I help people set up home-based offices. Nowadays is actually relevant, but it's not really what we do. So a lot of you see a view of the forest that our members don't see, that private investors don't see. And a lot of them are asking me, how is the health of the investment landscape? Like, not just tech. I know we're here to talk about tech, so we can comment on that as well. But just in general, the private investors in your networks, are they allocating at the same speed, the same amounts that they were 1 year ago at this time of the year? Are they allocating more? Are they allocating much less? Obviously, people are allocating to slightly different things. I think most people know that. But do a few of you want to comment on the level of activity you're seeing?
Sorry, did you say?
Go ahead, Skip. You can comment first, yeah.
I don't know that most of our members actually are doing that much allocating per se. My concern, as everybody's was back in late March, early April, are you going to invest at all? And we did a quick survey and found that they were definitely still interested in investing. The pandemic wasn't going to slow them down, most of them. I'd say the survey we did, less than half said, hey, we're waiting until 2021 and let this whole thing pass. But the majority were still interested in seeing deals. They still wanted to meet. They wanted to see the deal flow. And in fact, we made our single largest investment in May. It was the largest number of our members participated, and the total dollar amount was the largest we'd ever done. And that was in May. And then we closed on another deal just last month in July. So there's activity, there is interest and willingness to invest.
Right. Yeah, I'm seeing that as well. Internally, for our own balance sheet, for our company, we closed on a deal recently that was our largest one. And then we closed on one of our largest investor deals recently as well. I don't know if anyone's seeing the opposite thing. Is somebody seeing less within your network and maybe the allocations are smaller or not as often? Or are you seeing investors moving forward sometimes with even more aggressiveness because I think it's a better time to be investing perhaps?
I was surprised. Our group initially pulled back. I want to say we had a meeting in April that we deferred. But I have to say that I've been pleasantly surprised by how quickly people are looking at deals. We actually invested in 3 deals in the last quarter. And I also saw an exit in March, and so on both sides. And 2 of those 3 deals actually were oversubscribed. One was in the $2+ million for a seed deal that's actually a larger size. The other one set out to raise $1 million, ended up raising 1.75. So for the right kinds of deals, I would say that's actually key. Is I guess the next kind of conversation about what kind of deals are getting done. People are being selective, but they're not slowing down to invest. Right.
Okay, sounds good. And then we heard at the beginning about Ron asking some questions up front that most people can't answer or can't answer well. What other strategies do a few of you have to sort through the hundreds of things coming towards you to focus on just the couple that matter, that are the best fit for your network? What do you use as a sorting mechanism right off the bat to skinny things down and make it more effective?
Well, we just generally, the first thing we look at is, does it fit our portfolio? So it has to fit in with who's in our group. Every once in a while, we'll pull something in that really looks unique and different. But at the end of the day, a lot of times, if our group just isn't knowledgeable enough in that, so we generally, that's what we do first off. Because we have a small group here sitting out here in Morgan Hill. We're not in the heart of the Palo Alto to San Francisco corridor. So our groups tend to cycle around a little bit. and we get new folks in it. So we tend to focus initially, does it fit what our subject matter experts have in house? And then from then we simple down with some of the basic questions like that.
Okay, sure. Anyone else want to comment on their process of screening?
Well, I've spoken about it before, Richard. I'll summarize it again that we refined the process over the years to really manage the luxury of having a strong deal flow. Many of the groups here in the Silicon Valley do, and it's an embarrassment of riches, actually. And so figuring out how to sort it is a big challenge. I actually allege that angels have the resources to do a better job of doing that kind of sorting than VCs do at the early stage. A VC typically will source from their own network direct to the partner, and that's a choke point. And they've never really solved the scale problem of looking at unsolicited deals across a broad spectrum that come in unreferred. And that's the primary deal flow source for the band are unreferred deals that are coming in unsolicited. We look at about 50 a month. And what I'd like to brag about is that every one of those 50 deals gets looked at by at least 6 members of the Band of Angels, all of whom, could be VCs. They'll have walked the walk. They've started or run companies. And they rate those 50 deals on basically a survey monkey. So we never we don't have to meet the company. That's another choke point, but we did get a rating. So every one of the 50 deals gets looked at by 6 people. Every month we get a list of those 50 deals stack ranked by the survey monkey rating. And then we meet in person with a subset, usually about 10 to 20, depends on the month. And we pick the 3 that come to the monthly meeting where we actually give them a full opportunity to do a broad-based pitch and engagement with the whole group.
Sure. Great. Okay. I have another question. Does anyone else want to comment on their screening process up front because you have a really unique strategy or something that really simplifies things very quickly?
Yeah, Richard, I'll add that it's not really a different strategy. It's just a different place. And using the Gartner hype cycle, right, where you've got the innovation and then the elevated expectations and then disillusionment with individuals. The individuals on this panel, other than me, right, are going to be much better at that from an angel perspective in terms of assessing and filtering through that. Our view is trying to strike that balance between what is capital preservation and growth these days for families. And so when we look at it, we really pick up the 4th stage, which is that slope of enlightenment, the language used from the hype cycle. It really is that slope of enlightenment that ends up filtering out some of the items that the rest of the panel is probably picking through to get to that point. That's typically where our client families then are engaging. Unless they are the innovator themselves, that's what they'd be looking to participate after some of the things have sorted themselves out.
Great. Can I add to that? Because of the COVID thing, and we have a narrow focus at Kale, we're really big on collaborating with other early stage investors, both angel groups and individuals. So we're really big in having high talent and different skill sets so we can better scope an opportunity. Because by definition, these new ventures are doing the new. And so you need to have different perspectives, like whether it's operations or sales or technology or business model or being a futurist or whatever, is having these different skills at the table or on a Zoom call to be able to compare notes. So if there's 3, 4, 5, or 6 of you and the thing looks good from different perspectives, your confidence goes way up. There's probably something here. And so this is where you try and pool intelligence and these different skills to understand the deal, but also when you talk with the founders, it's more intelligent. And when you talk to the founders, if you go in with intelligence and you get intelligence back, it's probably a good thing. It's a foundation, in fact. And if it's not that way, they don't engage. They just want what they want. They want your money, and they'll get back to you. And we don't do that. So you have to have these guys who are really understanding how to work with outside investors, leveraging their skills and capabilities and networks and so forth. And we've been quite surprised with how few founders kind of understand this stuff. And this is huge, because if they don't understand it, it dramatically increases risk. And the secret to winning in early stage investing is managing risk. And the first thing to do that, you have to recognize it. And many folks struggle with that.
Right. Yeah, and I found that some early stage CEOs don't respect risk either. They act like there's no risk. Or in one deal I was looking at, they gave themselves a $10 million valuation, saying that in year 2 they're going to do $5 million, they'll do $17 million in year 3, et cetera. It was in the Amazon business, but they had been in the Amazon space for a decade, and the most revenue they'd ever done was $2 million. I said, well, does the investor get half the company when you don't do 10 million in revenue? It seemed that happens quite often on the valuations. I find it's always a magical hockey stick, and there's a lot of risk involved. So one question I get from investors is that they hear these quotes like in the Wall Street Journal and other places from I think the founder of Airbnb. I'm going to say it wrong, but he said something like, these 7 months will be like 7 years of technology evolution, and like everything's going to the cloud faster. Everyone's using Uber Eats more. Everything's becoming more virtual, work from home. Those are some obvious top level things that everybody sees, but all of you spend 80% of your life probably thinking about the second order effects of that, the not talked about effects of that, what people are missing, where the real impact is that never gets talked about by journalists who have never worked in angel investing or tech. So what would you say to investors or investment firms watching about the impact of the pandemic and COVID, and how are you allocating in a way that's not, like the herd of all angel investors chasing the same things? Like, how are you being a half step ahead of everybody who realizes things are going more virtual and cloud?
Richard, there are some unchanging investment principles, and we heard Ron just talk about it. For example, the quality of the leadership, the quality of the team, and their ability to create what I call sustainable competitive advantage, or their defensive moat. Those are really, really key stuff. But in the pandemic informed and post-COVID environment, what I'm looking for, and I think generally speaking, smart investors are looking for, are agility, so awareness of the new risks presented by this environment, and awareness of the new opportunities. And so you look for CEOs and leaders who are already thinking ahead, looking ahead, or preferably acting in this new world. I'll give you a couple of examples. I recently talked with a air filtration system company. They've been developing a clean air filter, but they adapted for COVID so that it would specifically kill viruses and bacteria, but directing airflow in the right way to go into classrooms and workplaces and so on. That's an example. Another one is, I don't really need to talk about this, but online mental health is huge. Companies that are going virtual in every way, is being favored. But the most important thing is not just defensively managed risk by managing your runway by laying off people, but really proactively looking at the opportunity presented, even down to the point where you say, okay, I'm in this place in the market, and how do I competitively win against my who I compete against, right? So I saw somebody interview yesterday on TV actually, who said, because of our supply chain strength, we're now 50% of the unit shipment in our market. And so companies that looked at or considered their supply chain agility, right, who were able to flex with the environment and quickly and actually win against competition. That's what I'm looking for.
I see. So less of a niche within a niche, more so of that attribute of being highly agile and showing that you've already adapted, I guess, as part of.
But also the defensive and offensive thinking of the leaders, right? So it comes down to the people, always, but especially in a fast-changing world, it comes down to the team even more.
Sure. Okay. Anyone else want to comment on what they're focused on right now?
I'd like to second Catherine's comment about, she calls it agility. We call it flexibility. That is really an attribute that Richard is paramount in making this sort of really early stage investing work. The typical life cycle of an investment of a company that we back, that many of us back, is going to be measured in 5 to 8 years if we're lucky, often 10 plus. And over that lifetime, you're going to have dramatic changes in the marketing landscape. COVID's an obvious one we're all related to, but to take a technical other example, the introduction of iOS 14 overnight is changing the digital advertising business for Facebook, which has been covered well by the Wall Street Journal just this week. But a plethora of other small digital ad tech companies that were existing in one environment that all of a sudden have had the table turned upside down on them. So companies that survive or not are going to, of course, be somewhat constrained by what their technology is, but a huge attribute that makes for a winner versus a loser is the market knowledge and ultimate adaptability or flexibility of the entrepreneur to adapt to the new situation. So when we're thinking of new investments to make, it's not so much tactical around COVID. Tactical around COVID is PPE, about adjusting, a PPP about adjusting your burn rate, taking advantage of new opportunities. For instance, we just invested in a therapeutic that might help attack respiratory infections at the mucus layer. So that's very COVID related, but the next wave is what you have to look around the corner for, things like AI at the edge. Not really clear how that's going to evolve yet. And if we're lucky, the market will evolve in the right way to benefit the companies we invested in. If we're unlucky, the market may not evolve that way, but if we invested in the adaptable entrepreneur, he or she might be able to win no matter which way the market evolves. So that's kind of our view of it.
Sure. Makes sense. Okay. And then in terms of due diligence resources, I think investors and investment firms could benefit maybe from a few of you commenting on any due diligence software, tools, a process, whether you use like a due diligence questionnaire after they get past a certain stage and now they're allowed to present. Do you put them through the ringer on 70 questions, or is that after a presentation goes well? If you want to comment on any due diligence insights or tips.
Well, we don't really use any tools. Again, we're not like Ian. We don't have 300 investors in our group, so we don't need a massive range of tools. We're pretty straightforward on it. But I would like to sort of leverage out what we're talking because it kind of fits in here as well. One of the things we're looking at more and more as we're looking at due diligence and digging through the companies, as we said, it's one thing to look at the company, what they're doing, but we kind of look at ourselves as kind of being the same place today with AI that we were in 1990 with computers. You know, I remember 1990, that's probably when I plugged my first computer into the internet on my 3400 baud modem, you know, and, but we knew the internet was coming and we knew all this stuff. And I think we're in a similar area with AI. So one of the things I'm seeing in a lot of the companies, you know, even at the early stage, you know, they've been told that they have to be coming to us angel investors and they have to have a product ready to go and realize, hey, we're ready to go, we're off the shelf. And I was like, well, we should have been talking 2 years ago then. If you're off the shelf, we'll get a loan and launch your product. So what we're looking at is future proofing. And we're seeing a lot of companies that come up with really good ideas, but they'd have been a really, really good idea as a next generation SaaS model, but not the next generation smart SaaS model or the next generation smart tech thing. So we're seeing them come up solving what I call today's problems, but a lot of them are missing tomorrow's problems. And like Ian said, we really don't know what the IoT and this AI thing is going to really look like in 3 years. So we're trying to, you know, sort of see who has a clear pathway to that. So that's where we see ourselves. And so we're just, a lot of times we're going through due diligence and there's no future proof in there. It's like, well, where's an AI thing? Are you going to manage any of this supply chain with blockchain or smart contracts? And so I think some of them are missing the technology on the next hurdle. They're looking at the transition to SaaS models, not the transition to AI-driven tools.
Right. But I think, you know, over 24 years, Ian, based on your description of how you select people to present, I'm guessing you've got a multi-step process for due diligence. And John, in your case, because of the sophistication level that's expected from some of your investors to advise them on multiple areas, I'm guessing you guys have a due diligence process that's relatively rigorous. Are there any tools or any insights you can provide from either of you on what you're using to conduct due diligence on these early stage companies?
Ian, you can go ahead first and I'll
Okay.
follow up.
Well, I was going to say, what we emphasize in our diligence is the culture and the team. It is less the technology. I mean, it is for sure. How do I say this? We talk about the technology, we talk about the market risk, we talk about barriers to entry, and so on and so forth. In talking about all those things and investigating them with the startup, we learn about the management team's way of thinking, their adaptability, their flexibility, and their market knowledge. And the deals that we tend to invest in are those where other things are credible, the surrounding context is credible, but really the exemplary feature is the market knowledge of the entrepreneur and how much they convince us that they are adaptable and flexible to changing information and circumstances. They're just, I should say there's an exception to this. There's a whole class of angel investment, which you would call small ball. These are deals, say 3 engineers who quit Intel, knowing the roadmap of an Intel chip development, and they're going to make the chip and give Intel a make versus buy decision 5 years from now. That's a very specific diligence-based procedure, and to some extent, medical devices and biotech investing that we do inside the band also lend themselves to specific diligence. But most other early stage investments at the stage we're at don't lend themselves well to diligence. Consider if someone came and proposed Uber or Airbnb to you back when they first came, and now we all accept that as a given, but you can imagine the objections that were raised then and seemed very plausible about the inability of those things to succeed. And what would have perhaps pushed you over the line, and indeed did push VCs over the line to invest, were the team and their vision. And they managed to adapt to circumstances, right? Airbnb was originally literally air, bed, and breakfast, as in their model was inflate an airbed and provide breakfast. It was not renting whole homes or doing vacation rentals. It was very prosaic and evolved over time. So into what it is today. So I hate to say that we don't have any tools, because for sure we do, but I wanted to emphasize what we're really looking for at the end of the day is a qualitative assessment based on judgment of people that have spent their lives building companies or running them, about the adaptability and market knowledge of the entrepreneurs that we back.
Those are very, very good points, Ian, because we like that stuff as well. So you're really trying to get into the headset of the founders about how well they really understand the market compared to opinions or conjecture. And so we have tried to really understand where they're coming from, because as you said, the thing with agility and flexibility is really important. And one thing we've noticed is these young ventures do at some point need to go through a pivot or two. And for that to happen, the better look ahead you have, the better. Whether it's data-driven or you just learn faster or you get better insights, a greater pool of knowledge to draw from or whatever. And you start, making calculated adjustments in your go-to-market strategy or the business model or what the technology is or what the product is called or who you go after. So a lot of these things go into figuring out how to create wealth, how to manage risk. And key to that is this look-ahead capability and this brain trust with your different complementing skills and talent and experiences to help figure this stuff out. Because by nature, venture investing is about the new. And in many ways, that's a crapshoot. So you need to be smarter about how to reduce the risks and better manage the odds so that you can win. And that's all about the people and about this brain trust and about just how to monetize value creation. And time is of the essence. Because you're right, Ian, about the 5 and 8 year time frame. Like some of ours are 10 to 20 years. And boy, a lot of things can happen and go wrong in that time frame. So the more you're on the same page going in, the more fun it is, more rewarding it is, and it's faster to get results.
Right. Well, related to oh, go ahead, John.
I was just going to add, it's been said, right? The world has never moved this fast, and it'll never move this slow again, right? Which is just, in terms of the pace that we're all talking about, the flexibility, the agility, the risk management that comes into place. And this world is not slowing down. So to continue to go back to the basics, right? The relationship depth that's there when you talk about it from due diligence, the risk management, the understanding the people that you're working with, and also sticking to the spaces that you know. So, fintech families. And I was working this morning with a couple partners going through an event right now, but participating in the roll-up that is taking place and what that looks like, because the scale and the speed that's out there with the cheap cash that's chasing it, this is just going to continue to accelerate. So the nimbleness and the risk management being job number one is also sticking towards what we know versus trying to get too diluted or too early stage, right? I'll be the first one to admit the angels on this panel are going to be better at sorting out some of those early things. As they sort through that, we come in then and say we can deploy more capital into it.
Right. Makes sense. We have a certified blockchain nerd in the Family Office Club who's one of our members, and he says that if he meets with somebody and he knows more than they do about blockchain, then he doesn't invest. And that's related to Ian's point about, just seeing what type of knowledge they have, what type of insight they have, what type of expertise. And like Ron was talking about, that's how you de-risk the investment to some point, is just to dig into the intellect of the person and the quality of the team. Everybody says team is most important, but having tangible, clear, consistent ways to actually vet a team besides this person seems nice and has things in common with me as a human being is, I think, a challenge for people early on investing or at investment firms, especially in the angel investments space where the risk can be so high. I wanted to also comment on structures. So with the investments that you're doing, are you guys using convertible notes most often, safe notes some of the time? Are there new structures that you're using, or is it really the same for every deal? And can you share, an insight or two on what structures you like best and why? And I'm happy just to have a couple of you comment, or we can all comment, whatever you'd like.
We're seeing a lot of transition to many more opportunities or deals are doing debt, doing convertible notes as opposed to equity rounds. Not sure why, other than I think the pandemic caused a lot of entrepreneurs to say, wait a minute, maybe I can't raise that A round, that $5 million that I need. And instead, let me just do a bridge to get through this process and raise, what I need to get 12 to 18 months of runway. I'll do it as a convertible debt for now, because I also don't trust the valuation that I'm likely or not likely to get. So we're seeing many more of the deals that are coming across our desk are convertible debt. And so we're passing on, that's causing us to pass on a lot of deals for that reason. But but that's the trend that we're noticing.
Okay, great, thank you. Anyone else want to comment?
Richard, I have been railing against convertible note. Safe is even worse. Obviously, most investors prefer a price round because they know what they're getting. And nowadays, with the qualified small business tax, no tax provisions, the earlier we can get into a price round, the better we all are. And so in that way, for most investors, our strong preference is and should be price rounds. However, price rounds are very, very expensive, especially for very early stage companies, somewhere between 30 to 50,000 in Silicon Valley to get one done, just in attorney fees, right? And so it's not the most efficient use of capital for a lot of these companies. This is why convertible notes have become very popular. There is a thing that a lot of people are not aware of, but we have seen it in Silicon Valley many, many times. It's called SeriesSeed.com. It's a set of documents that are ready-made, available for early stage companies and investors to go to. So it looks to actually provide a way to get a price round done at much more reasonable prices. Of course, now there are also lots of different versions going around with edits and so on to make sure that it still fits the round peg and all that stuff. But that's a really good, short, easy way to get a price round done that's less expensive.
Sure. Okay. Anyone else want to comment on structures you're using or that you like or don't like? One thing that I'm curious about is we've gone into a couple of early stage companies that have revenue. They're not seed or pre-seed, but they're revenue positive already. And we've negotiated a gross revenue royalty to get our money back off the table quickly. And typically in 3 to 5 years, we have 100% of our money off the table. And what I've done now with 3 of them is had or with the last 2 actually, is had a equity warrant instead of equity. And we basically, once we get 1.2 times our money back from the gross revenue, then our equity goes down, say from 5% to 3%. It's almost like they bought back some of that equity. And so us as the investor can recycle our cash into the next deal. The warrant allows us not to get diluted if they'll agree to it, but the warrant's a little bit of a distraction from the topic of just the gross revenue royalty approach in general. A lot of you have seen hundreds of deals get done over time. How many of you have found that approach to be helpful or have seen anyone using that type of an approach just to get the capital raised faster by getting people their money back?
Oh, Richard, I love that structure. Please send me, next time you do one of those, send it to me. I might want to invest myself. Sure. Truly, it's great to get your money back early, but that I'm imagining, and tell me if I'm wrong, because I don't know the particulars of that deal, that's just a fundamentally different kind of business proposition than many of us are talking about, at least here in the Silicon Valley, Catherine and Gary and Ron, because the thought is that we're trying to shoot the moon on a lot of these companies, and money given back to investors is money not invested into the business, and in a steeplechase of trying to get across the finish line first, as is often the case, that's cutting off your nose to spite your face. So maybe you'll get your money back, but your equity won't be worth anything. So we are always on the lookout for things like that, but it would be hard to imagine the deal where that's possible. In terms of the high tech deals we do. Like Gary mentioned, once we've been looking at some ag tech deals. For example, one of our companies is doing a vertical farm and before COVID, it was going great because they had a contract to do all of Emirates Airlines food production in the world's largest vertical farm. That's a high tech deal that was going to throw off a lot of cash, and a structure like you just described could have been possible. But what wouldn't have been possible is for that structure to have survived the next round of financing. And whoever the next guys were who were coming in to finance this ag tech company, I'm sure would not have accepted us having a premier priority dividend over their investment. So I'd love to know more about those companies you just described. It's a clever strategy if you can get away with it, but not typical for high growth, high tech, and very high return, 100 to 1 kind of ambitions for an investment.
Yeah, it makes sense. I mean, some people react and say, oh, well, why would a CEO ever agree to that? They'd have to be a dumb CEO to agree to it. But what I found is that it can be used to make it smart or dumb for either side, right? So like one family I just met with just sold their portfolio for $100 million. They're growing their next chain of retail locations. And, one thing that I told them is like with a royalty, you could give back the money to the investors. So they get 2 times their money back and they go away. And then they retain all the equity, and the equity goes from 5% to 0. Because now you doubled your money in 3 years. Like a certain type of investor will want that. I know you don't, Ian. You're looking for the 20 times, 100 times return. So I think that you're right. For the very early stage, when there's no revenue yet, there's no royalty possible. And for other reasons, it may not make sense. But yeah, happy to keep in touch on that.
Richard, I would be very interested in seeing a rough cut term sheet on that, something like that. Interestingly, I just had this conversation with a couple of angels last week. People have been talking about how do we construct a revenue-based return deal for a while. And I think we really tap into a different part of somebody's portfolio, especially since it's a family office group of audience. Different people have different kinds of return expectations and risk comfort and all of that stuff. And I would say that when you have a more cash flow focused deal versus a growth model deal, the returns are very different and the risk profile is very different. And of course, the investment methodology and structure should be different. So, it's just another tool in the bag.
Right. We're structuring a deal right now with a $10 million a year dental clinic chain using the royalty stuff. I'm happy to send over a term sheet example to both of you.
Thank you.
And there's a company on Amazon called Better Bath, Better Body, and we've done a couple of royalty deals, with them as well. If anyone has questions that are watching here live, feel free to submit your questions. Otherwise, I'd like to go around and get one last insight or comment from each person here on the panel. I feel like maybe Skip, maybe I didn't ask you enough questions during the panel. If you want to start first with any last comments or insights and something you wanted to really get across during the session here today.
I don't have anything super exciting or out of the box. It's just that I keep reminding people, though, that deals are getting done. Commerce is still happening. 80%, 85% of the people that want to be employed are in fact still employed today, and they are spending. Tech companies in particular, a lot of them are actually growing through this pandemic because of opportunities now that exist that may not have existed, a year ago. Investors are willing to invest. So, we're not sitting on our hands, and we're not just waiting for things to happen. We're making things happen, both as investors as well as the entrepreneurs. And so I find that very positive. That's what I love about our free enterprise system. Things happen, and we're all working through this. And it's different. It's an exciting time, but it's still going forward.
Right. Great. Yeah, no, I couldn't agree more. I think you get rewarded for more high action right now rather than less. Gary, any last comments from yourself?
Well, going with what Ron's saying, absolutely chaos, breeds opportunity if you know how to see through the fog of the chaos and find it. But from an investor side, one of the things when I look at a lot of times with especially early investors that are coming in is don't fall in love with the technology. We're going into some technology areas now with AI and stuff, and the technology is going to be really cool again. And it's so easy to fall in love with the technology and lose sight of all other flags that are going on around you because you've fallen in love with the technology. That's kind of a simple one right there that I see often.
Right. For sure. Great. I appreciate you sharing that. Catherine?
I actually want to advertise a few deals that I'm seeing that are of interest. One is a B2B2C, guiding consumers to a healthier way of eating, but it's a B2B2C, and they have, I believe, a platform and a business model that can potentially consolidate what is right now a highly fragmented business. Repeat entrepreneur, seeing, they have signed over $5 million in total contract value, and the deal is priced at $10 million or so, price deal. There's another company, it's a portfolio company in medical devices, adapting quickly to try to become a COVID relevant testing platform for at-home testing. And they're actually deferring their FDA process to be ready for the market for blood testing with trials. And so there are a couple of deals like this that are actually happening that I think have relevance to the market today. So I just want to say that, if you're interested, let me know.
Great. Thank you. John, any last comments?
One of the other panelists mentioned that there's other parts of the family office balance sheet. And we also have to think about tech, right? We've talked a lot about the very early on, the angel side of things. UBS just came out with their 2020 Global Family Office Report, and there still is 59%, allocated typically towards traditional assets. So when you think about the tech opportunities that are out there, there absolutely are that these individuals have mentioned and are talking through and are looking at. But the opportunity, given this acceleration of adoption rates, whether it be genomics or fintech, or we've talked about artificial intelligence or cyber or autonomous or energy storage, you go down the list, there's all kinds of tech opportunities that are continuing to accelerate in that curve, both in the very early stage that the individuals are speaking about, but also in the public markets. So having that balance across the family is important, and there's all kinds of opportunities that are out there that have great potential because this is going to continue to speed up for all of us.
Right, for sure. Ron, any last comments?
Sure. So we really recognize the need to support entrepreneurship, and also for the need for early stage investors to collaborate. So this is really important to be successful and make it a sustainable business. So if any of you on the panel or others listening have ventures with technology of interest to enterprises, either as customers for them or as partners in the go-to-market strategy, feel free to contact Kale.
Okay. Ian, any last comments?
Sure. Since I'm presuming what your audience might be interested in, I'll put in a plug for angel investing and a caution. I think angel investing can be frustrating. It's easy to lose all your money or a large portion of it. It's also an asset allocation segment that can be wildly rewarding. And that very high variation makes it hard to say anything generalized about the segment. Whenever I'm speaking to investors who are thinking of an asset allocation, I always say that angel investing is really worth investing in as a category, but as a very small part of a large allocation. Its returns, especially if you do it in just a couple of companies, are very volatile and can often be zero. I know angels that have done 5 or 6 investments and all of them have gone to zero. People that have built larger portfolios, depending on how they built them, can have an increasing chance to really get outsized returns based on the occasional outlier in that portfolio. So as I mentioned earlier, we didn't invest directly in Airbnb. Rather, we invested in a startup company that was quickly acquired by Airbnb early in its history. And it's going to turn out to be an extraordinarily lucrative investment for band members. And it wasn't so much that we were smart as we were kind of lucky. We invested in a team that was adaptable, as Catherine said, and managed to adapt their way all the way into being acquired by a unicorn. And so that outcome is only because we invest in a lot of companies. And so if you're thinking of investing in this category, you really ought to have a strategy to invest in a bunch of companies, and then the returns can be worth it.
Right. Yeah, I guess part of that message is the worst thing to do would be to see 4 to 10 deals a year that you have access to, invest in a couple of them per year, and do so haphazardly because your chances of losing your money are excellent. And instead, you should use your strengths, where you made your money, maybe look at that industry, access a couple of angel networks, learn what groups like John are doing on the family office, VC angel investing side, and combine all of that and make sure you don't go at it like the golf club, yacht club investor who they see 4 deals a year. So one of them looks great and they allocate, right? I mean, that's literally one of the dumbest things you can do as a private investor is you don't even know how bad your deal flow is. So your number one deal is 1 out of 4. I think that for any investor who just had a liquidity event, I would just make sure and heed that advice because there's so much to learn and such a steep learning curve to go through to manage all the risks. We had a question from Eric here. I don't know if one of you would like to comment on this real quick and then we'll sign off. His question, because I know he runs a high-tech company here in the club, is would you prefer to invest in a company that's asking for $18 million their first year, or a company that raises $6 million a year over 3 years and then not have a profit until year 4? He's basically saying if they raised $18 million up front, maybe they could have a profit in year 2 versus do $6 million per year. It's hard without any other context to probably make any comment on that, I realize, but any comments on it, I guess, just to be helpful to?
It's impossible to answer without knowing the context, as you say.
Right.
Somebody just now said, it all depends on what happens, and a company and an entrepreneur has to be able to be adaptable and be agile. So without knowing anything, I would say that dumping 18 million into a first business model and first attempt is probably foolhardy unless it's absolutely buttoned down, safe. So absent any other information, I would say, hey, bet small so that you can pivot as you go.
Right. Yeah, and I think so many times we get questions, not just on discussion panels, just over email. And it'll be, I really like concise emails, but sometimes they'll just ask you something without the context. No one on planet Earth can answer that question, really. And, I don't know if anyone else has a comment on that or anything else.
I would say, if you were to say fundamentally with nothing, like I said, with nothing else to consider, one of the primary things of the startup model is speed to market. So if it achieves speed to market and reduces risk, yes. If it achieves speed to market into a brick wall, possibly not.
Right.
To back up Gary's point with Uber was out trying to raise, I don't know the number, I'm going to make it up, $10 million in their first round. When they got their round done from Benchmark, it was for $40 million because the thought was, if we're going to do this, let's do this, let's buy it, let's make it happen. So raising more money can make sense, but you're not going to get that from angel. So to your gentleman's point, for this panel at least, that is mostly made up of representatives of relatively smaller check sizes, we just wouldn't look at a deal that's raising $18 million. That's something for NEA or Excel, not for smaller investors.
Right. Okay, great. And one last comment is Catherine and Gary both made comments earlier that reminded me of something I'm seeing more often. It's just not that everyone has this attribute, but there seems to be a slightly outsized success ratio for those who are ex-military, veteran, quasi-college level or professional athletes or black belt, martial artist type people that just have high discipline, high work ethic. And when you combine that with being agile, it just seems like in the investment space, I see an outsized percentage of those people operating in an excellent way and having SOPs and KPIs and really executing. And it's just something I've been seeing recently in the space. So I appreciate everyone joining us here today for the panel. We'll have this in the member portal in just a couple of days in case you want to share it with someone on your team. If you'd like to connect with any of the panelists that you saw here, just let Jennifer know on our team. You should be connected to her already via email, and she can help get you connected to a couple of the panelists here. We're going to have a virtual influence workshop coming up in September. I believe it's September 19th, if I'm not mistaken, and it's a 4.5-hour workshop on influence and persuasion related to the investment industry and how to make more progress, getting people's attention and getting them to work with you or take meetings with you, et cetera. We also have our first commercialrealestate.com Power Players Summit coming up later in September 24th. And then every week, typically between now and then, we're releasing investor interviews, discussion panels, or doing a live webinar, et cetera. So make sure and coordinate with Jennifer to do your membership walkthrough if you haven't done that yet. And I appreciate everyone's time here today, joining us here for the panel. Thank you, everybody.
Thank you.
Take care. Appreciate your time.